Hi everyone, welcome to our monthly video post. Yes, you guessed it right. This talk is going to be on the budget, but not the usual one which you're being flooded with. We are basically going to be talking about the risks, if any, from this budget. Budget is an occasion to make ballistic statements. Though every such statements are dissected to the last word by the frenzied media, it's quickly forgotten to in no time. Historically, beyond theatrics, budgets have rarely served any purpose. As a result, over time, budgets have come to be seen as an exercise that is sweeping in scope but short on specifics. But over the last 2 years, something seems to be on the serious mend, especially after the current team has taken charge in North Block. Of course, the initial slips were scary. One can hardly forget the regressive start in 2019. But post that slippery start, this particular team seems to have come very high on the learning curve, especially if one goes by the latest one. So if you go by the market response, this budget looks like a great success. Market has lapped it up with all cheers because of the growth focus the budget has brought. And there's nothing in the fine print that could upset the equity markets. So given the capex push, the economy facing stocks are likely to do well in the coming years. So in effect, the budget is going to be pushing the strong economic momentum which the country is already seeing. So beyond all this, is there any risk from the budget for the markets? That's a question we are going to explore in this talk. So if at all there is any risk for the markets from this budget, that's going to come from the bond markets, not from the equity markets. As many of us would know, there's been a huge increase in the net borrowings for this budget. From the current year of about 8.75 trillion rupees, the expected borrowings for the next year is going to be somewhere closer to 11.5 trillion. The bond market was not expecting this huge increase. They were looking at somewhere around 9 to 9.5 trillion rupees for the coming year. But this has come as a huge surprise for the bond markets. Also, the bond markets were expecting some kind of tax concessions for FPIs so that the global bond inclusion can get expedited, which the budget has not given. So as a result, there's a lot of pressure on the 10-year yield in the bond markets. Already the yield is up close to about 30 bips from the day the budget was presented. And if we go by what the yield was trading in last October, it's already about 120 bips up from the last October level. So there's a huge pressure, there's a huge sell-off in the bond markets. So what is in effect is likely to do is, it's going to make it difficult for RBI to continue the accommodative stance which it has been doing. So the next monetary policy is going to be really interesting to watch out for. So given this pressure on the yields, should one be alarmed? In our view, some bit of interest rate hikes is par for the course for a growing economy. But this kind of large borrowings, will it put pressure on the yield to get into a disorderly movement in the bond markets? But the key thing is, will the disturbance in bond market, will it make a disorderly movement? Here one can take comfort or solace from one hope. If you look at closely the budget numbers, one is seeing a lot of conservatism in the revenue projections. Take the GDP growth number that has been assumed in the budget. It's about 11.5%. But if you take economic survey as the cue, the economic survey is talking about 8.5% real GDP growth. So if you take a conservative inflation number, about 4.5, or even 5%, the nominal GDP growth is going to be well above 11.5%, which the government has assumed. So which means the government has got a lot of leeway in terms of fiscal space if the growth numbers are going to surprise on the upside. So we feel the government has got a lot of flexibility as the year unfolds to change their borrowing calendar. In case the bond market is finding it difficult to absorb the increased borrowings. So even if you look at the current year and if you look at the numbers very closely, initially government had estimated close to about 9.67 trillion rupees as the borrowing, but later as we look at the numbers, they are likely to end up less than about 8.75, which means close to near 1 trillion rupees it's going to be less for borrowings. So in effect, I think government even the coming year will have a lot of flexibility in terms of their borrowing calendar. Having said that, this is of course one great risk one has to closely watch out for as the year unfolds. With this, let me conclude this talk. Happy value investing. Thanks for watching this video. See you in the next. Thank you.